All right. So welcome again to day 2 of Back to School with Simply Pips, where we try to build a foundation for proper understanding of the new wave of trading, AQZ. Right. We mentioned yesterday that when you open your chart for the very first time, you either zoom in or zoom out. You have either of these two types of view on your chart. And they are practically made up of candlesticks. One way you could look at them is candlesticks, and candlesticks a form of depicting the relationship between price and time. So here you have an MT4. To the right of my screen, you have price, right? And underneath, we basically have time. So this is actually a graph of price versus time. If I turn this to a line chart, sorry, somebody's annotating. Please desist from doing that. Right, so this blue line, zigzag line, actually denotes price versus time. If you have ever gone through basic math in secondary school, you would have been taught something that has to do with maybe quadratic or something like that, where you have a graph of X, Y up there and X, and you're plotting your graphs. You know, then you draw the line, usually parabolic. So this is actually a graph of time against, price against time. But to help us understand it properly, a Japanese man brought up these candlesticks, which we use, and that's why we call it Japanese candlesticks. So it's actually just telling us the interaction between price and time is the change in price with time. So basically, right? So, and we mentioned that this price changes because of human psychology, right? Basically, our actions and reactions, which are broadly divided into fear, greed, and sentiments. Price goes up because some persons feel that it's cheap enough to get in, and that they have a feeling that price is going to go up, and therefore they'll make money. Whether we call them market makers, they are seeking liquidity or whatever, somebody had a sentiment that price is going to go up. And even after price had gone up a little, somebody heard that price was going up and decided out of fear of not missing out, which we call FOMO, jumped in at a higher price, anticipating that price will continue to go up. Or somebody who came in low and have made 20% growth still feels price is going to go up more and doesn't want to get out, and that is greed. So I've explained fear, greed, and sentiment there. That is why price either go up or down. There's a news that Elon Musk or Tesla sold 10% of their crypto assets, and some persons want to sell off their Bitcoin. That is fear, right? Fear, you know. So that's basically what moves price. You and I as retail traders, we buy because we have a sentiment either given to us by indicator or whatever, that price is going to go up. Right. So if I'm sitting here in Nigeria and I'm trying to gauge what your sentiment is, or the sentiment of other traders are around the world, there is no way for me to know what they are doing. I could basically see what they are doing based off of what the candlesticks are doing. So when we put the candlesticks together, they form patterns, and these patterns are repeated, right? And any serious trader, we want to understand what these candlestick patterns are. So we went into candlesticks and we discussed the anatomy of candlesticks. We won't go through that again, but the basic ones we saw, we actually looked at the bullish engulfing, the bearish engulfing. Put together, we'll call them the engulfers. Then we saw the pregnant woman, which is the inside bar, again, could be bullish or bearish. Then we saw dojis and various forms of doji. Pin bar is a form of a doji. We also saw the tweezer, which is another form of a doji, and the doji itself. We said the tweezer, the inside bar, and the the tweezer, the inside bar, and the pin bar are candlesticks that connote indecision, and we'll wait for certain things to happen before we go into the trade. Whereas an engulfing is a sign that either the bears are in control or the bulls are in control. And we try to narrow it down into AQZ qualifying candles, which was where we stopped yesterday, and we'll continue from there. All right, so here we have the AQZ qualifying candles, which are basically two of the type of candles we had discussed prior to this time. We have the traditional bearish engulfing candlestick, right? And we mentioned that there are two ways you could basically trade off the bearish engulfing. The first one is to enter once this candle closes. Usually advised for pairs where the distance, the range between this point and this is not wide, right? Second entry will usually be you wait for price to pull back into this zone, and then you begin to look for opportunity to enter. This is the traditional way of trading a bearish engulfing. When we get to AQZ itself, we'll find candlestick formations. We will divide these candlesticks into bearish candlestick formations and bullish candlestick formations. So let's start again from bearish candlestick formation. So a traditional bearish engulfing is on its own a bearish candlestick formation. A bullish engulfing that has been violated. Remember, for a bullish engulfing, we would have been looking to buy either from 1 or 2. But if price comes back and closes beneath the body of our bullish engulfing, we say that the bullish engulfing has been violated. Now, remember yesterday we tried to say there is a tussle between buyers and sellers within our candlestick body, right? The range of the candlesticks, right? So if we are hoping to buy because we find a bullish engulfing, is because we have the notion or the sentiment that buyers are in control. Now, if sellers come to, violate the buyers, it means the buyers here have been eliminated. The sell pressure was so high that it annihilated the buyers here. We would change our buyers to sell. We would change our buyers to sell. So, a violated bullish engulfing is a bearish candlestick formation. A violated bullish engulfing is a bearish candlestick formation. Here we have a bearish pin bar. Again, we mentioned that we'll box it up from top to bottom. If price closes beneath, this gives us a bearish candlestick formation. Note the choice of word close. Close. Price could wick and jump back up. We would not see that as a sign of bearishness. We'll wait for a close to confirm that we are bearish. Keyword there is close. So 3 candlestick patterns here: bearish engulfing, a violated bullish engulfing, and an inside bar with a bearish breakout. The next candlestick formation, of course, the flip side will be the bullish candlestick formation. Now, in a bullish candlestick formation, of course, the traditional bullish engulfing will be 1, then a violated bearish engulfing. Notice for violation here, we are placing a line flushed on the body of the bearish and the bullish candle. When price closes above, we say that this bullish engulfing has been violated. Or the bearish engulfing, I beg your pardon, has been violated, means the sellers here has been destroyed and price is pushing back up. Again, that should simply tell you that there are buyers at the bottom of this wick. If you remember what we explained yesterday, if you are watching this video and if not watch the day 1, you need to go watch the day 1. So sellers sold up to this point. There were some buy orders here And once those buy orders were triggered, it was so heavy that it consumed all bearishness here, and now the bears are now trapped. You would be going in the direction of the bulls. So this is a bullish candlestick formation that is a violated bearish engulfing. Then when we have a bullish inside bar with a close above our zone, that is a sign of a buy. So the bullish inside bar itself is not an indication to buy, it's an indication that buyers are in the market, but you still need to wait to be sure that the buyers have actually taken control to resume your buy or to begin your buy, as the case may be, because there are times that even though there are buyers in the market, price could just close lower. And if our bias is for a buy, we would not buy at that point. We'll stop here on this and go to the chart to practically see how we can use this. We're building a foundation to take us up to how we trade this, which will come up maybe on Thursday and Friday, right? So let's just take it slowly. In case you know all this already, sorry for taking your time. All right, so here I have with me a chart of GBPNZD on the 4-hour time frame. We have a chart of GBPNZD on the 4-hour time frame. I would be starting from around 22nd of July 2020, just so we could get good example here. I would be using 2 horizontal lines to mark out our points. So let's follow. We would start from the lowest point here. So again, if you've been following, the candlestick pattern we have here is a bullish candlestick pattern, a bullish engulfing candlestick pattern. And we said we have 2 ways you basically trade it, either from the top, but we traditionally want to use price coming back to cover the tip of this, which we'll call the bridge. So here we have a bullish candlestick pattern. One of our line will be at the bottom of that wick, and the second will be at the top there, right? So we'll traditionally want to go for a buy when price returns to this zone. You see, so price returns to that zone, and then we entered our buy straight up. Again, this happens to be a winning trade if you look at this alone. Now, this formation itself here happens to be a bullish candlestick formation on its own again, right? That happens to be a bullish candlestick formation on its own. What is our rule? We would anticipate to enter for a buy either from the top or from that spot, right? So it's either you're going for a buy from this point or from the top, right? Notice how price came, never really touched it, but again, our bias is for a buy, and then we're in for a buy. What candlestick pattern do we have here? We have an inside bar candlestick pattern. After buying for a while, we have an inside bar candlestick formation, right? So let's say you just come into the chart for the very first time. The first thing you can see is an inside bar candle formation. What should you do when you find an inside bar candle formation? You basically have your line up there and another one beneath, right? So that is your range. You're waiting for this is a bearish inside bar, right? But notice that price closed above. Once price closes above, we are basically bullish. So we would be entering for a buy when price comes back to the top blue line. And you can see that right away. Price came back and then we bought, right? Off of this inside bar. Again, let's watch something. Leave out the inside bar. This candle that caused a breakout from the inside bar invariably gave us a bullish candlestick pattern. Again, how do we Now let's move on. When price pushed up, it's an inside bar candlestick formation. How do we treat an inside bar candlestick formation? We basically take the top and the bottom, and we'll wait for price to close beneath it, and exactly what happened here. And when price is beneath, we'll be waiting for price to go back up for it to drop. But in this case, price most likely came back down into this bullish candlestick formation. So right here you can see a bullish engulfing. Price came into the bullish engulfing and then bought, right? So we would continue to buy as price moves. Watch this again. So we have a bullish engulfing candlestick pattern. Price traded into the bullish engulfing candlestick pattern, and we would have been in a buy. If you are looking at the bearish inside bar, you would have had a close beneath the bearish inside bar, and then you will be looking for a sell. Believe it or not, you had some sells. Price traded back into it and then dropped, right? So price finally closed above the inside bar. Price closed above the inside bar, and that is a sign of bullishness. I just want us to see how we play this and why we need to have rules, right? So right about here, if you follow the rules as I've mentioned it now, if you follow the method as I've mentioned it now without some rules, you could easily get confused. Now the question is, should I be obeying the bullish engulfing, or should I be obeying the inside bar, right? But again, we're just stating the obvious. We'll come with the rules later on. Okay, so let's move on. All right, so here we have a bullish engulfing. Price came to it. Now, price gave us another bullish engulfing pattern here, right? This is a bullish engulfing pattern. Again, we would have been waiting for price to come back into that zone and to buy. Price came into the zone the first time, bought, second time, bought, third time, bought, right? Until this bullish engulfing candlestick pattern is violated, we would continue to buy. So price traded all the way up and then gave us an inside bar. When we have an inside bar, what do? We box it up, and then we hope to see a break to the downside for sells, or a push to the up, a break above for a buy. And let me expand this even more so you all see. So you notice we had a break above. Maybe I should make this a little bit darker so we could fine. I think we can make deal with this. So here we have a close above the inside bar, right? And once we have a close above the inside bar, what does that give us? Signs of bullishness. And there we are buying, right? We might want to call this an inside bar, bullish and small bearish candle. So let's call that an inside bar too, just for the purpose of this. So here we have an inside bar. Again, we are waiting for price to close above. Price closed above. Price came back down and price bought. But some other persons might have seen this other inside bar at the top, right? And this was a breakout from that inside bar. This was a push up. This was a test of this inside bar, a push up, some form of sell, and price broke out. Again, I'm just stating the obvious. We'll go to the rules, how to determine which of the inside bars should take preeminence. But for now, we're just stating the obvious. Right, so here we have an inside bar like I earlier mentioned. Again, we could box that out and then wait for a close above to resume our buy. This was the close above, this was the retest, and that was the buy. Keeping it simple. Here again, we have another inside bar. And what do? when we have another inside bar, we basically we basically box it up. Notice that my on the candle to the left, right? The same thing with this. The candle to the left from week to week is our inside bar. We're waiting for price to close above or beneath, right? We're waiting for price to close above or beneath. Now, watch what we're saying here. If you are impatient and you don't wait, this was a dip to the downside. At some point in time in the lifespan of this pin bar, it would have been all full-bodied bearish. Full-bodied bearish. If you jumped in for the sell, well, you might have caught some things, but sorry for your loss. This sell was only coming into this zone, right? Which is a bullish engulfing. And we said when we have a bullish engulfing, how do we trade it? We either wait for price to come to this point or the tip, right? Exactly what price did into this bullish engulfing and then went to the upside. But again, we're just keeping it simple. Just candlestick patterns. You have your inside bar here, and notice how price kept playing. They were basically accumulating. We'll understand that by tomorrow, or rather sometime today, we might discuss price structure. So notice they were basically accumulating within this range. Right, so notice how price broke above. And when price broke above, we would have been anticipating buys from within this box, and then price never really bought. So from that analogy, this will be perhaps a losing trade. But at the peak, at the topmost point, now we have a bearish engulfing. So what do we do when we have a bearish engulfing? We anticipate price coming back into that region, and then we sold off. At some point, we had a bullish inside bar. What do we do when we have a bullish inside bar? We box it up again from week to week of our reference candle. Notice how price closed above the inside bar, and that gave us signs to buy. Unfortunately, we might not have caught this buy. The price pushed on and gave us another inside bar, right? Price pushed above the inside bar, right? Again, these are inside bar there. Price broke above, came back to test the inside bar, and then we bought. So you're either looking at this inside bar or you're looking at this bullish engulfing. Both of them would have given you similar thing. It was the bullish engulfing would have waited for price to come back to the red candle to buy. If it was an inside bar, a breakout, you'd have waited for price to come back to your box, and then you would have bought. Whichever one you take, that would have been a winning trade for you. Now, at the topmost point, you have an inside bar. Right, topmost there, you have an inside bar. Price traded into the bullish engulfing and then bought. Then price closed beneath. Okay, for the inside bar, we'll box out this, right? Price closed beneath, came in, attempted a sell, and then price went back and closed above. When price closed above this inside bar, it becomes sign of bullishness. So we will be buying anywhere from here, and that's exactly what happened, right? Now, at the topmost point there, again, we have a bearish engulfing. We would be anticipating price coming back to the tip of the bearish engulfing for us to sell. price never really sold. And then we have, I just remember I've not mentioned this. I'm going to mention it now. And then we have a violation of the bearish engulfing. So this is a bearish engulfing candlestick pattern. Here we have a violation. Remember what we say violation is? We say we have a violation of the bearish engulfing when a bullish candle closes line flushed. Then this becomes a violated bearish engulfing, which is a bullish candlestick formation. So again, we'll come back here. We have the bearish engulfing candlestick pattern. We have the violation, and then we have the buy. Right? Again, remember, we're just stating the obvious. No rules yet. We have fixed rules to trade this. Just stating the obvious for now. All right, so upon the buy at the topmost point, push. If we find something that looks like a tweezer, but let's leave the tweezer out and just consider the inside bar. Now, if you use an automated system, it might call this a bearish engulfing, right? I would not see this as a bearish engulfing. I prefer my bearish engulfing to be domineering, something like this. This, for me, will pass for a tweezer, which was why we discussed that candlestick pattern. And we said a tweezer is a sign of indecision. We said a tweezer is a sign of indecision. So when you find a tweezer, it's like price bought and then sold back, straight back to exactly the same point or similar point from where it bought off from. That's a sign of indecision. So what should we do then? We should box it out and wait for price to close either beneath or above to form our bias, right? So here we have price either closing beneath or above to form our bias. Price closed beneath, we would have been anticipating to sell, but then price went back up and closed above, and we would have been anticipating to buy, and then price came back again and closed beneath, and we would have been anticipating to sell. Here we have some sells, and price went back and closed above, right? So if we use our candlestick pattern, we would have got, confused here because price was basically ranging, right? So at the topmost part, I'll soon stop, round up this now, so we'll move on to the next point. At the topmost part, we now have what we call an inside bar, right? Notice that I keep going for the one with the highest range, right? We have an inside bar. This is the widest range. Price closed beneath. We would be anticipating sales from there. And then, of course, price continue to sell. So if you have that, if you understand candlestick pattern the way we've explained yesterday and today, you could basically look at the chart and then decide to take your trades off of your knowledge of the candlestick patterns. And there are many ways you can set rules to it. We have some specific ones for AQZ. I'll just state one on the side. We don't use this for AQZ, just on the side, so you can understand how with candlestick patterns and some simple rules, you could basically trade the market knowing exactly what you want to do. So I'm going to state some rules that just for the purpose of the next few minutes, and then we'll move on. Right, so here on my chart, I have a 20 EMA, right? I have 20 exponential moving average, and the moving average is to give me direction as to what I should do, if I should be buying or selling. And the simple rule is if price action, the candlesticks are above the 20 EMA, I'm looking for buy opportunities, and the candlesticks are below the 20 EMA, I'm looking for sell opportunities. Let's just take that as a rule for now. And now, so second rule is that when I'm above the 20 EMA, where I'm looking for buys, I would be looking out for bearish candlestick patterns, and I'll be buying upon their violation. Meaning I won't be planning to sell, I'll only plan to buy upon the violation of a bearish candlestick pattern, right? So that means that when we saw this bearish candlestick pattern, right, which is a bearish inside bar. Remember, we discussed that. I'll remind you again. So here you have a large candle and a small bullish candle. This is a bullish inside bar. And when we have a large bullish candle and a small bearish candle, body to body, this is a bearish inside bar candlestick formation, right? So let's move on out here. Let's say for the purpose of just this discussion, this is what we have agreed to use. So what candlestick pattern can we have here? A bearish candlestick inside bar, right? Bearish candlestick inside bar. So what do we do when we have a bearish inside bar? We basically box out the top. We won't be planning to sell. We'll only be planning to buy because we are above the 20 EMA. And price basically closed on with this candle. Price closed above and violated the bearish candlestick pattern, and this is our buy, right? Then we have another bearish candlestick pattern up there, which is again another inside bar. We would be buying upon a violation of that candlestick pattern, and then we go, right? Again, we'll have another one here. Upon a close above, we are basically buyers, right? And so on and so forth. So with this simple rule, you would avoid the sells and only look for buys until price closes back beneath the 20 EMA. This is just, you know, an arbitrary rule, just to let you know that you could sift out some of these things and decide how you want to take the last one. So have again another bearish candlestick formation. Price closes above, and is a sign of bullishness, and that is the buy up there, and we continue, right? So let's move back as we try to wrap up in some few minutes. So we've been able to discuss the AQZ qualifying candles. There are basically 6 of them. We have the bearish engulfing. Then we have, we broke them into 2, right? There are 6 candlesticks, but we broke them into 2 groups. The bearish candlestick formations and the bullish candlestick formations. I won't repeat them. You could always watch this video later on. So let's move on. All right. So now that being said, we will be discussing price structure, even if we can't finish, and then we'll continue tomorrow. So price on its own does basically 2 things. Everybody that has been trading for a while knows that it is either trending or ranging. And what does that mean? What does that mean? Right, I'm trying to call up, don't know why it's not coming up. We won't allow that to stop us. We'll move on with this. All right. So if I squeeze this in completely, what you would find is price basically, let's have red here. Price basically doing something like this. If you can see clearly, it seems to be dropping lower and lower, temporarily pushes back up, then drops even much lower. We wouldn't go through the nomenclature, but usually we'll call this a high and call this a low. Then we'll call this a lower high and call this a lower low. And like that, it continues lower high and lower low. So when price makes consistent, continuous lower highs and lower low, we say it is trending downwards. And when it does the opposite, going upwards, we say it is trending upwards, right? So if price is trending downwards, we are predominantly sellers, and when it's trending upwards, we are predominantly buyers. However, there are times in when in price structure where you can't say for sure what price is doing. For example, in this region, you can't really say what price is doing because it isn't really making higher highs and higher lows per se, right? It dropped all the way down, then came back up, dropped down, came back, like dancing within this box. When price is not making consecutive higher highs and higher lows, and it seems to be dancing around, we say it is ranging. We say price is ranging, basically. And when price is ranging, we could still use our candlestick patterns to trade them, even if it is ranging or trending, because there is a trend inside a trend, and there's a trend inside a range. There's a trend inside the trend, and there's a trend inside a range. So I'll explain that as we, perhaps that might be what we'll end today's class with. So I've opened this a little bit more so we could see price action even clearer. Right, so here in the range, some people call this supply and demand, right? So we're going to do something right now, and we'll use that to determine some trade. So we have a box right here. At the topmost part here, we have a bullish candle. Let me expand this a little bit more. We have a bullish candle up here. And that bullish candle was, violated. Once this bullish candle is violated, we could basically box out that bullish candle that was violated, box it out completely. We could box it out completely. The bullish candle that was violated. And whenever price comes inside that box, we begin to look for reasons to buy or to sell, right? Then we have another box at the lower part here, the bearish candle, right? The bearish candle or the bullish engulfing candle, as the case may be, which is the bullish sign, and this is the bearish sign, right? Again, we could box out that one. Whenever price comes back into this zone, we will look for signs of sell. Price came back into that zone, we look for signs to sell. Price came back into that zone, we look for price to sell. Price came back into that zone, right? We're looking for reasons to sell, and so on and so forth until the zone is broken, violated. Here we have signs of bullishness. When price comes back into this zone, we'll look for signs of buy. And when I say signs of buy, I'm talking about the candlestick pattern we have discussed ab initio. So here we have the candlestick pattern, which is bullish. So when we have a bullish engulfing, we are waiting for a retest of that bullish engulfer to buy. Here we have an inside bar. You're looking for a break beneath the inside bar to sell. Here you have an inside bar. You're looking for a break beneath the inside bar to sell. Right? Here we have an inside bar. You are waiting for a break of the inside bar to sell. In fact, at the first touch here, you would have had an inside bar, but price never came back to break below. It broke above and gave you another inside bar, and you will be looking for reasons to sell. Here we have an inside bar, but rather than price, let me expand it even more so you could see. So here we have an inside bar. Price never broke beneath it. Price rather went above and gave us a bullish engulfing candlestick pattern, an inside bar, an inside bar, an inside bar, then a break beneath, and that is when we sell. Again, price came to that point, gave us an inside bar, a break beneath, and then we sell. price came to that point, gave us an inside bar, but never broke beneath and then went above. So you notice that if we understand the candlestick patterns on their own, and we are willing to be patient, we could trade price any direction, either way, whether in a trending market or a ranging market. And you see the H4PC. I'm assuming we don't know what the PC is, but when we get to that point on Thursday, you see how the H4PC helps us to trade, be it in a range or in a trend, we could actually trade them. So if I squeeze this in and say we have a trend, so what you and I would traditionally do is draw something that looks like a trend line. Permit my assumption that we all know what a trend line is. I'm going to remove every other item here, and then we expand this even further, right? Just to let you know that the AQZ we're discussing about, is trading the basics of price action, the very basics of price action with or, yeah, somebody said, but we didn't have known it's a range. Yeah, you wouldn't have known it's a range. There's a rule to know that you're in a range. And because I'm not discussing, the aim of this teaching is not to tell you how to trade a range or a trend. I'm just developing how you could trade different systems using pure price action. Of course, for you to know that you are in a range, you need to have two touches. So price goes up, falls, comes back the second time. It is after price has touched the second time and rejected, then you call this point the top point, which we usually call our resistance. And when price bounces the second time from beneath, that is when we begin to say this might be a support. And then we'll intend to trade from the support down. That is when we now call this, it can work on any time frame. That is when we call this a range. So we need, for price to do anything, we wait for two touches. If you are in a trend, you can't say you're in a trend until you have two touches on your trend line, which is basically the high and the lower high, the low and the lower low, then you say you're in a trend. You wouldn't know you're in a trend in the first instance, right? So I'm not defining the trend. I'm just letting us know that even if you're a trend line trader or whatever you are, if you use price action the way we're explaining it here, you basically trade the same way, right? So here, let's assume that we already know that this is a trend. What was the last candlestick pattern we have at the top there? We have an inside bar that was, that became a bearish inside bar that held true. The last bullish candle there is the candle of reference for us, right? So we would basically box out that bullish candle, right? This is our bullish candle. We are basically boxing it down, right? I wanted to do this on TradingView. I don't know what happened. All right, it came up finally. Okay, but I've started drawing here, so let's finish up. So here you see that last bullish candle. The last bullish candle there is a candle of reference if you want to trade this. Whenever price comes into that zone, you look for signs of bearishness to sell. Signs of bearishness to sell. And what is the sign of bearishness you're talking about? Either an inside bar that has been violated, a bearish inside bar or a bearish engulfing, and that would have supported your sell all the way down. And you do the same thing for a buy. Pick the last bullish candle that was violated, the last bearish candle, I beg your pardon, that was violated, and you have that to the downside. When price comes in, you want to see for signs of bullishness. So in this case, you have a bearish engulfing, an inside bar that was violated, and that would have been your buy signal, right? Again, this is not what we're teaching. We're just trying to explain that whatever the strategy you want to use, these candlestick patterns can actually work anywhere, right? So let's move on. So price does lower lows, lower highs, and the likes. So I've been able to explain that. All right, so of course, I just explained supply and demand, principles of large candles. We'll be discussing the principle of large candles tomorrow as we begin to narrow down specifically to the AQZ, right? So if you use this pattern, you could follow the trend in its basic form. You are not predicting that you know where price will make a U-turn from. You are just chasing price as it moves. Yes, I chose the word chase. We are not assuming that we know what price will do. We're basically just trading it, right? So traders of supply and demand can also use these principles. Tomorrow we'll start from principles of large candles, trap candles, and then we'll begin to go down into the AQZ fibs itself, how we could streamline that. So maybe I should just whet our appetite a little with that for those of us that perhaps might not understand the AQZ. Right, so whatever strategy you trade, if you, I just don't know what's happening to my Chrome. It seems to be crashing on me. All right, whatever strategy you trade, if you understand the basics of these candlesticks, the way we've explained it today, you could basically fit it into any strategy, and you know exactly when to get in if you're not trying to pick the tops and the bottom, right? Without necessarily following your indicator. So let's say you love the stochastics or you love the percentage R, and it's telling you you need to buy now, but price action is telling you otherwise. Price action is what reads the interaction between price and time, not your indicators, right? Price itself, the candlesticks are the things that read the interaction between price and time, not your indicators. All right, so let's go back to H4 and see something here. All right, so here at the topmost point here, what candlestick pattern can we find? We find an inside bar, right? I'm just whetting our appetite. We'll get into this tomorrow. So we have, and usually when we have an inside bar, what do? We box out the candle to the left, right? In this case, the bullish candle. So we have a fib we call the AQZ block, right? I'm going to use that fib to basically box out. So you can see that this is actually a box, and that was why I intentionally used, two blue lines at the beginning to delineate our range, which is the candle of reference. So our candle of reference in this case happens to be this. This is the highest point at this time, right? So notice a break outside that inside bar. When price returns to the tip, the lower tip, we are invariably selling. We are basically selling when price comes to that lower tip. And here you find price coming to the lower tip, and then there you see our sell, right? If price returns to that region, we would be looking for another opportunity to sell, right? So again, here, at the lowest point on our chart, what do we have again? We have another inside bar. This is the lowest point. The bearish candle and the bullish candle happens to be another inside bar. So let's say we fib the candle to the right, to the left again. Here we have our breakout. We have a return back for a buy. We have a return back for a buy. We have a return back for a buy, right? So you see that. Same concept. But beyond just knowing that, okay, I'm going to fib, why are we doing what we're doing? Which is why we actually spent 2 days breaking this down. So you could actually look at price and decide what you want to do, right? So we will, when we come back tomorrow, we'll be looking basically at these fibs and how to use them. And then we'll begin to narrow down to how to take the trades even off the lower time frame. I will stop recording right now.